Everyone thinks the Great Depression happened because the stock market crashed in 1929. But the real cause is way darker. Most history books point to one dramatic moment. October 29th, 1929, Black Tuesday. Stocks collapsed. Fortunes vanished. Panic spread. But the crash wasn't the disease. It was just the symptom. What really caused the Great Depression was a dangerous mix of greed, fragile banks, political mistakes, and a financial system built on illusion. And once it cracked, it pulled the entire world down with it. Picture this. It's 1930. Outside banks across America, lines stretch around entire city blocks. Men in worn-out suits clutch withdrawal slips. Mothers hold children tightly, waiting for money that may already be gone. Inside, bank managers are sweating. Cash reserves are evaporating. Phones are ringing nonstop. On farms across the Midwest, crops rot because prices have collapsed. Factories in Detroit are silent. On Wall Street, traders stare at ticker tapes that no longer make sense. People were panicking. Banks were melting. And economists were pretending they had a plan. But they didn't, because the real disaster had started years before the crash ever happened. Official story. The official story says the Great Depression was caused by the 1929 stock market crash. And yes, the crash was catastrophic. Between September and November 1929, the market lost nearly half its value. By 1932, it had fallen almost 90%. But here's the problem. Stock ownership in 1929 was limited. Only about 10% of Americans owned stocks. So how did a market crash destroy the entire U.S. economy? They blamed speculation. They blamed irrational investors. They blamed margin trading when people borrowed money to buy stocks. And it's true. Margin buying was out of control. Investors could buy stocks with just 10% down, borrowing the rest from brokers. If prices went up, profits were massive. If prices fell, everything collapsed instantly. But speculation alone doesn't create a decade-long depression. The crash was dramatic, but it wasn't enough to shut down thousands of banks, wipe out farms, and push unemployment to 25%. The crash didn't cause the Great Depression. It exposed it. Except that wasn't the truth they wanted to admit, because the hidden reason is much worse. Dirty secret behind the scenes, the American banking system was dangerously unstable. In the 1920s, the United States had over 25,000 banks. Most of them were small, undiversified, poorly regulated. There was no federal deposit insurance, no serious oversight, no safety net. Banks were allowed to gamble with depositor money. And they did. Many banks invested directly in the stock market. Others loaned heavily to stock speculators. Some made risky loans to farmers already drowning in debt. When stock prices began falling in late 1929, banks didn't just lose investments. They lost confidence. And in banking, confidence is everything. If depositors believe a bank is unsafe, they rush to withdraw their money. But banks don't keep all deposits in cash. They lend most of it out. So when too many people demand their money at once, the bank collapses. Between 1930 and 1933, over 9,000 U.S. banks failed. 9,000. Millions of Americans lost their life savings overnight. No insurance. No recovery. Nothing. And here's the darker truth. The Federal Reserve, the central bank created in 1913, had the power to stop the panic. But it didn't. Instead of injecting liquidity into the system, the Fed allowed the money supply to shrink by nearly 1/3. They believed in market discipline. They feared inflation more than collapse. So as banks failed, the Fed stood by. And that's not even the craziest part, because the government made it worse. Consequence. As the economy weakened, policymakers made a series of devastating decisions. In 1930, Congress passed the Smoot-Hawley Tariff Act. The goal? Protect American jobs. The result? economic warfare. Tariffs on imported goods were raised to record levels. Other countries retaliated. Global trade collapsed by more than 60%. Factories that depended on exports shut down. Farmers who relied on foreign buyers were ruined. At the same time, banks were failing and credit was disappearing. Businesses couldn't borrow. Consumers couldn't spend. Investments froze. This created a chain reaction that nobody could stop. Unemployment soared from 3% to 25%. Industrial production fell nearly 50%. GDP collapsed by about 30%. Prices fell, not rose. This was deflation. And deflation is deadly. When prices fall, businesses earn less. When businesses earn less, they cut wages. When wages fall, consumers spend less. When spending falls, prices fall even more. A downward spiral. And because America was tied to the gold standard, meaning dollars were backed by gold, the government couldn't simply print money to stimulate the economy. The gold standard acted like a financial straitjacket. Countries that abandoned it earlier recovered faster. The United States stayed tied to gold until 1933, and by then, the damage was massive. This was the moment the entire system cracked. By early 1933, the U.S. banking system had essentially collapsed. State governors were declaring bank holidays. Banks closed their doors to stop withdrawals. People were trading goods directly because cash was scarce. The American financial system, once the most dynamic in the world, had frozen. Confidence was gone. And when confidence disappears, capitalism stops functioning. It wasn't just a market crash. It was a systemic failure. Banks failed. Policy failed. Leadership failed. And ordinary people paid the price. But here's the part that still affects you right now. Hidden impact: the Great Depression permanently changed how modern finance works. In 1933, newly elected President Franklin D. Roosevelt launched massive reforms. The government created the FDIC, the Federal Deposit Insurance Corporation, insuring bank deposits so people wouldn't panic during crises. The Glass-Steagall Act separated commercial banking from investment banking, limiting risky speculation. The U.S. abandoned the gold standard, giving policymakers more flexibility to manage the economy. These reforms reshaped the financial system for decades, and they directly influenced how governments responded to later crises, including the 2008 financial collapse. When banks nearly failed again in 2008, policymakers remembered the 1930s. This time, the Federal Reserve injected trillions into the system. Governments bailed out banks. Deposit insurance prevented mass bank runs. They acted aggressively because they had learned what happens when you don't. Even today, central banks around the world are shaped by the trauma of the Great Depression. Interest rate policies, liquidity injections, emergency lending powers, all born from that era. And here's the deeper impact. The Great Depression changed how society views risk, wealth, and government power. It expanded the role of the federal government in everyday life. It created social safety nets. It redefined capitalism itself, the way your bank works. The reason your deposits are insured, the reason central banks step in during crises. It all traces back to that collapse. So what really caused the Great Depression? Not just the stock market crash. It was fragile banks built on confidence alone. It was reckless speculation fueled by easy credit. It was political mistakes that strangled global trade. It was a central bank that tightened when it should have loosened. It was a gold standard that trapped policymakers. But above all, it was human behavior. Fear, greed, denial, overconfidence. Finance isn't logical. It's emotional chaos with a price tag. And when the system forgets that, history doesn't just repeat. It crashes.